But let's welcome on board N Jayakumar in the studios right here to try and understand what he's making of the market. Jakes, hi, morning. I guess more than the capital gains adjustment, it's the global cues which are going to be dictating us, as is the case this morning.
And as indeed should be the case, right?
Should be the case,
I
yeah,
mean,
I
I
guess.
think all said and done, the budgets come and go. I think the roadmap's been re-emphasized, re-laid out. If it means taking a little more from the people who quote unquote are making a lot of money, which is through the markets, I think it's par for the course. I don't have an issue with that. I think growth needs to be inclusive. One of the big things post-COVID we've seen is that the disparity between certain sections of the society and people who are invested in the markets, for instance, has become substantially wider. And I think the government's more cognizant of that than ever before. The important thing is, did they need to do it? You could argue they didn't. You could argue they could have avoided it. But I feel there's a signaling that's essentially happening with this, which is that they want to be able to say that wealth needs to be more evenly distributed, which, while it may be a utopian statement, I mean, it's not never going to happen. But I think the fact that so many concessions for employment generation, for people to, get first-time employees, etc., I think are steps in the right direction. And the fact that the JAM Trinity, Jandan schemes, etc., have met with the desired destinations. So the government feels confident that they can actually get it to the people where it matters and in the manner that is befitting of, supporting the public at large. So keeping all that in mind, I think we should move away from the budget saying it is not all about taxes. But I think there's a very important, powerful message that's also come through. One is the signaling side. Any time in the last 35, 40 years where I've been in the markets, if taxes had gone up, and not one, you have short-term, long-term and STT, right? If they had gone up, the first and only thing the traders would do is to sell and ask questions later. Here, the correction was absorbed in 2 hours. It just shows that there is a far bigger tectonic shift happening in India, which is the story of the retail. That if 3% of household savings went into the markets, say 3-5 years ago, today that number's moved up to about 5.25%. And that alone is a wall of money that is supporting. And in most countries in the world, developed markets, which we hope to be over the next 15-20 years, this number could go to the middling teens. And you're talking about significant amounts of money for Capex, for corporate needs, for equity markets, etc. So I think that is the story. Even post-elections, the numbers were a shocker from a market perspective, and it lasted a day. Yeah. So I think there is a bigger story here. So as long as people are logically bearish, markets do not top out. If the public at large, and you talk to a few more people than we do, which is South Bombay, South Delhi, South Bangalore, as I call it, once that is out of the way, the greater India says SIPs have made us money. Yeah. The problem, which was that they were actually losing money on the F&O side, a lot of the first-time retail. So any deterrence on that side, which means people go more and more into long-term. Deterrence can be in the form of higher transaction charges or whatever. I think are steps in the right direction. So more money through SIPs, more money through mutual funds, and you want to do complex products, do it through mutual funds which will offer those. I think that's the name of the game. And quite honestly, I mean, for me, after nearly 40 years in the markets, the fact that higher taxes were shrugged off, and higher taxes as in higher in-your-face taxes, I think is a massive, massive sign of a completely new India that we are part of.
इससे ऊपर टैक्स कितना होगा जेक्स?
You'd be surprised. ऐसा कुछ नहीं है. I think as they say,
UK taxes and all, but those are different countries.
Watch what you wish for, kind of thing. So I don't want to, open a debate that says ki somebody is advocating for higher taxes. I just feel that if there is a signaling to be done through this, it's been done, and I'd be surprised if they tinker with it, which a lot of people.
The finance secretary actually was there on the channel, and we'll try and put an excerpt, and then you want to stay back and hear the FM also. She spoke to us. My question to him, or our question to him, was point blank, that what was the thought behind change of taxes? Is it revenue mobilization? Is it rationalization? Or is it convenience? He said, look, revenue mobilization was not the primary objective. By increasing taxes here by 2.5%, it's not that revenue is going to just go higher. It is about convenience and what we really want to bring out in terms of a asset class orientation with other asset classes. That's the primary objective, and we are in no hurry to increase taxes. beyond this, or tax rate beyond this?
I kind of agree with the first point, disagree with the second, and I'm, total agreement with the third. Not wanting to increase taxes is a good thing because we know that compliance increases with lowering of taxes. But the fact that you wanted to make it a level playing field, etc., you could argue that you could have brought down other taxes, not have to increase this. But
Not long term for sure.
But I think there's a fourth point which has not been brought about, which I keep harping on, which is the signaling fact. The fact that large swathes of India look and say, okay, the people who are making money are paying a little more, and guess what? In some form or shape, through the government, is coming back to us. I think maybe these are socialistic streaks, but I think it's a reality. I mean, look at parts of the US. The coexistence of the billionaires, along with looting of shops in San Francisco and in different parts of the US. It's true in Europe. So I think social unrest is out on streets in many parts of the world, and heavens forbid we have anything like that here. The fact that the government is focusing on this, to my mind, is a good thing. Whether they achieve, I think there's a series of steps. It doesn't need to be through taxes, but for the first budget after a new mini coalition, if you will, between you and me, I'm perfectly fine, and I have absolutely no misgivings. And this is not a political statement. I mean, even in private things, I've said, if I have to pay a little more, because I happen to be blessed that we are in a market where we've all sort of enjoyed the fruits of tailwinds. I'm completely okay with it.
And given that we have you for a very short period of time, let's get in a sense as to what your advice is at a time like this. Some of those preferred sectors, telecom, infra, generic pharma, if you could walk us through that.
So nothing has changed. So if you keep budgets aside, and at one level I feel budgets are like speed breakers on a highway. You don't expect them, but they happen. And you don't expect any accidents, but the speed breaker comes, you have a little bump and you move on. Let's say that's out of the way. You go back to basics now. I think we must focus on, from a structural perspective, on sectors that are not just dependent on India. Of course, on the local side, there's Capex, recycling, sustainability. Those themes exist. So you've got to deep dive a lot more than has happened before, because the easy phase of the markets are over. You need to be there. Even today, the pharma basket has a 6% weight on the index. And you look at balance sheets, completely deleveraged. You look at opportunities. Quarter on quarter, the US publishes numbers on shortages. It's happening to Europe. So if there's shortages in different parts of the world, there's pricing pressures that have abated, and Indian balance sheets are strong. Companies have started, announcing buybacks and, measures that can bring investors in. And most important, index weightages are low, which means these are under-owned spaces. So pharma is I'm a big believer in pharma. I don't want to talk specific stocks given, the SEBI diktat on this, but that's one. The other side, of course, is, themes that involve infrastructure creation. I think the telecom infra space is big. Towers is one we can talk about. We can talk about data centers. Those are themes that one should look at. And these are, again, spaces not completely overowned. And given that markets are at elevated levels, but from an index perspective, it's still at a 20-21 PE, depending on, the way you look at numbers, maybe 22 if you want to be a little uncharitable about some downgrades that could happen. Given that kind of thing, it's not optically expensive. Therefore, I'd probably stay invested in the large caps or the larger caps compared to many of these. So as I would say, sustainability, recycling, waste disposal, that's one, that's a smaller theme. Maybe chemicals if you want to be, but that's, again, China dependent, so you've got to be a bit careful. But definitely the larger spaces, telecom, infra and pharma would be two names that I would be very bullish on.
When you see a company like Vodafone getting rescued by equity market, so debt is getting rescued by equity market, what does that mean? I mean, it's amazing, right?
Since 1947, you could argue that Indian enterprise has never had genuine equity capital.
Yeah.
Because we've talked about crony capitalism, etc. So other than large groups, nobody really put money as equity in terms of their contribution. Over a period of time, you now cut to the last 10 years, the new age, where literally every money that you spend can be tracked. Yeah. Startups are being financed. They come back to you and say, we are burning cash. Or burning cash is part of the Capex process, right? If you include pre-operatives, that's...
Yeah, of course. You're building a brand, you're building a business, you're building a supply chain.
Right. So now for the first time, India is seeing genuine equity coming in. view Vodafone 2.0 or 3.0 as a startup, but with licenses, with certain things, etc., which now gives you a chance to, and it needs equity capital because it's undercapitalized big time. If you look at 2 lakh crores, yes, part of it, 35,000 may disappear with the AGR dues being settled in their favor, but it still is undercapitalized. Now that process is happening compared to, let's say, its larger competitors. So while I'm not recommending that you should buy that, but the fact that 3 or 4 large players are becoming much stronger means that the entire infrastructure they will use becomes stronger. That's why my telecom infra preference and the fact that equity markets are supporting these also means that people are being generous about the fact that if the protagonists are reasonable. Who are the protagonists in Vodafone? The government is the largest shareholder. The Birlas are there as a large shareholder. So given that, you're backing, quote unquote, a 3.0 startup in that space. So, view it that way. So I think the equity markets in that sense are being very discriminating. People talk about markets being irrational and pockets of exuberance. Every market will have pockets of exuberance. What's the big deal? The standard question that's asked is Siemens and others are quoting at 100 Ps or ABB is quoting at 100 Ps. To talk some other. The fact is they were all quoting at these Ps even 5 years ago. But 5 years there's been no earnings change. 5 years there's been a stock price that's moved up 4-5x, but earnings have moved up 4-5x. Before that, 5 years they did nothing.
No, their Ps were higher, Jakes, because there were no earnings.
There were no earnings.
P ऐसे बढ़ जाएगा.
No, the stocks, the market's telling you we are paying up for growth.
Exactly.
Yeah. Right? 2000 to 2020, 2010 to 20 belong to B2C plays. 2020 onwards belong to B2B plays. The same pockets of private sector, which, banks, etc., which went to 3 times, 4 times, 6 times book in the case of Bajaj, etc. Those are now getting derated, but the PFCs and RECs that are lending to the B2Bs are moving up. So it's clear shift. There is Capex happening, there's investment happening, and people who are lending to these are getting played. So there is, to that extent, there is full rationality. Markets are paying up for growth. And even today, some of the names I mentioned, the big engineering giants are operating at 70% capacity utilization.
Yeah. So, Jakes, let's divide the market in very few buckets. One, which is the end of the market, which is cheap and has potential to get re-rated, which is one end of the market where you think that it is now compounding. You're not going to make big gains. It's all about a 10 to 12% earnings growth and stocks will catch up. And which is one end of the market where you think that there is a P top, where next 3 years, either you will get no returns or the returns would be much lower than what the average market would do.
So I think the way I would look at it is slightly, I'll go along with what you're saying, try to see if the same template can be.
Whichever you like, I'm just trying to put a thought here.
Yeah, so the template is right. The market, remember, is paying up for growth.
Okay.
Where does growth come from? Growth in earnings can come from either if there's a capacity surge, which means they add new capacities, or they're utilizing capacities better. So some of the engineering giants are at 60, 70, 80%. Could they go to 100%? Whether private sector or public sector, the answer is yes. The other space is metals, mining, commodities, where they've had single-digit EV/EBITDA multiples. But if there's a deleveraging play there, the deleveraging adds to equity value. Integration adds to equity value. So how does equity value get created? Either if debt gets replaced through earnings, or new capacities are put up and the same equity then is able to get sweated out that much more. So I think we need to look at that. So if Capex is happening in the engineering space, minerals and mining space, pick up the integrated players, pick up those who are cutting down on costs. Because remember one thing, mineral resources can't be recreated. So those in possession will, now there's been case of 1 or 2 in this play, again, not wanting to talk specifics, where the same group has gone for multiple rounds of equity financing, whether at the holdco level or here, etc. These companies are getting deleveraged. So if nothing happens and commodities plays just move up 10-15%, but at the PBT level, the operating leverage could be much, much more. So that is the space to look at. The derating plays actually the multiple to book plays in the financial services space, which is
derating. You're talking
the derating, DE, D for Delhi, for instance. And the reason for the derating is deposits are moving to the capital markets. Therefore, banking and financial services, which are consumer focused, are forced to now, and the big top tier borrowers have all raised enough money from the equity markets. They don't need money other than for working capital. So there's no spread on that kind of activity for banks. So they are forced to go into the retail, SME and the quote-unquote higher risk spaces. So which means that fundamentally if you're at 3 times book or 3.5 times book, those spaces and over-owned because everybody came to India, they wanted the big banks, they wanted, those could be spaces where growth may have, in a sense, could be a challenge, or their risk profile may increase, or they may actually, if there's a balance sheet issue, come in for further issuances. So there I would say you need to walk away from, because the private sector plays still are over-owned. And if you look at the foreign portfolios today, whatever the ownership, 16-17% of the Indian markets, 50% is in over-owned spaces.
Yes.
So
IT
they
banks,
they are
IT.
forced to sort of switch that out, or consumer spaces, where number one paints company, 2% drop in turnover, 25% drop in EBITDA. When was the last time you saw this? So you know the writing on the wall in some of these spaces is there. And you therefore have to move to spaces that you've been uncomfortable with, which is Capex, Infra, roads. These are spaces you've been uncomfortable with, and good balance sheet. So that's the way I think you should reorient yourself.
Absolutely. I know we've extended our appointment with you by a whole lot, but
No, thank you.
So glad that you could wade through the torrential rains outside.
I'm
and
glad
make
that
it-
last aspect was mentioned about wonderful rains in Bombay, but a challenge to walk into studios.
talking
you
about
very much.
infrastructure.
Yes, absolutely. Thank you so
yeah.
much for having me.
Thank
Lovely,
you.
lovely.
Okay.